I'm here.
Yep, good. Chris Labrie here. Okay,
Here,
good to see you. And James, who I think replied to an email earlier today, right? That he would join remotely.
Yes, he did.
All right, so he can join whenever, and we can catch him up. You know, there'll be inevitable Q&As and whatnot as we go. So just first order of business, I want to welcome, or perhaps it's even welcome back, Chris, to the RPAC. I don't remember if any of your prior roles and responsibilities with the town was on the RPAC. If it was, it might have been before my tenure here, but greatly appreciate you stepping in and filling the vacancy of Amy, who was with us for, you know, like most things, too brief a time, but nevertheless. So welcome, Chris. So moving on, I need a motion to approve the minutes that Diane circulated with the materials.
I'll move to approve.
I think I can move, right? To also, I mean, I can second that. Is that right, Diane? I thought I could.
Yes.
yes,
And I was there, right? So that all works. So then the minutes are approved with Colm and me as a second. So thanks for that. And so we have some meeting dates that are proposed. You all can look at those. We can, if you think you have any issues with that, we can take these offline with Diane. I think the one caveat for these is just to please bear in mind that with the news of Vanguard exiting the business on the defined benefit side of the house, there will inevitably be a need for some special meetings, and we'll work closely with Diane to get notice of that out to you all and try to clear those dates as well as we can in advance. But in terms of regularly scheduled dates, I thought that these were just fine. I don't know if Chris or Colm, you had any thoughts or ideas or objections?
I had no problem with them. They all appear to be fine to me.
yeah, same here.
Yeah, fair enough. Okay, so good. Thanks for that. So then I guess we should just on the defined contribution side of the house turn things over, Diane, right, to Bill and Michael, and you all can walk us through your analysis. You will have seen that Diane, Coleman, and Chris, Diane not only emailed all the materials, but they're also loaded on your tablets. So if you have it, we have the security benefit materials and Michael's materials as well. So so very good. So off to you, Phil, on the security benefit side.
Appreciate it. It's been a while that we've had a chance to catch up. Hope everyone's doing well. I know we were going to do this in person today, so it's been just over 10 years to bring you and refresh everybody maybe that aren't familiar with it. The security benefit kind of took over the defined contribution 457 plan. One of the challenges way back then, I think, was not only participation, but also just making sure all the ducks were in a row from a plan document standpoint and everything else. So for the last 10 years, security benefit has been the town's 457 and 401A provider for your employees. What I've got in front of you, and I'm going to walk you through a few things today. I'm going to walk you through some of the report card that's disseminated out that Diane and Cheryl get, and I'm not sure if they send this to you on a regular basis as a committee or not. These are analysis that we do on the fund lineup. We'll walk through that. We'll walk through some of the changes that just took place back in December that we traditionally do annually. We will then just kind of high level some of the attributes inside of the 457 fund-wise information, things like that, kind of more of a Q&A. So if you see something you want me to stop, please ask questions. I know some of you may have put some down already because you had this material ahead of time, which is great always to have, and we can go through that as we go through the report card here and the other things. So by way of starting, I guess I should ask, is there any questions before I get going? Tom, you're muted. So
I think whatever I have, I'll just jump in where it strikes me as it's more relevant rather than anything
Perfect. Okay. And that's what makes it nice in this forum to be able to do that. So by way of the beginning, basically, this report we put together is how we manage in the criteria and look at the funds that are inside of the 457 and 401A plan defined contribution plans. We monitor these on an ongoing basis, similar to what you would see out there in a 401k type environment, except this is a fiduciary type plan, since it's non-ERISA, plan versus an ERISA plan. We look at the 3-year and 5-year total returns of these funds. Their median or peer have to be greater in the category. The risk level, their Sharpe ratio can't be, no less than 75% of their peers, again, in their category. So we're doing apples to apples, oranges to oranges, making sure everything lines up. And we also monitor operating expenses to make sure they're not going outside of what they should be doing in their categories. If they do, just like in at a teaching forum, it's a report card, it's a scorecard. If they do that on a monthly basis, quarterly basis, we put them in a watch list and then needs attention list. And what happens is typically every fall, we come up with what the need attention list is. We look at the category and see where we need to make some changes and then make those recommendations. And that's automatically done on behalf of all the employees as well as the plans that we monitor. So nothing really needs to get done in that sense that somebody has to take action. It's just things we do as a best practice to make sure it's not just the current employees that I remind everybody that's in this plan. There's also retirees that still have money in the deferred compensation plans that we also are monitoring and making those changes for those that keep it inside of the plan as well. So you got all your categories in here, and I'm not going to go through them. You have your target date funds, your large, your mid, your smalls. And so this is kind of what it looks like, and this is the report card. So the green is always good, right? NA is not applicable, and those are for end-of-year index funds. We can't match them up against their peers since they're the index in that category. Watch list, kind of your caution. That means they've, for three plus consecutive quarters, they have failed one of those criterias, and needs attention is when they get to 6+ quarters, so a year and a half, basically, and we're going to monitor and make those changes. So when you go down the list, you've got a few that are popping up on here that needs attention that we're looking at potentially for changing the latter part of this year. And I'll go through this in a minute. We made some changes as of last year where we took 3 different funds out. We took a mid-cap value fund, we took a PIMCO small plus stock small company fund out, and an impact high yield as well. And they got remapped to other funds that we'll talk about in a minute. Right now, based on this 9/30 scorecard, and we're in the process of doing 12/31, since we're so close, just past the end of the year, we've got 3 funds that are looking for potential removal in the fourth quarter of 2024. All Spring Discovery Small Cap Growth. There's a mid cap fund as well by ClearBridge, and a Loomis Sales Global Allocation Fund that potentially could be removed out of here in a couple quarters from now, toward the end of the year. Questions on the process or procedure?
Yeah, Phil, I'm just wondering, so if these best market practice criteria for which you take a particular fund and you put it in one of these categories, and then you have the related criteria or protocols where if they remain on that list for some duration of time, so this isn't just a one-off, right? This is sustained performance for whatever reason, or sustained charges that are not in keeping with its peer funds, right? There's a change. And I'm just wondering, in that case, is it fair to say then that the level of turnover, that the menu of funds that participants enjoy in these plans, that level of turnover will be no greater than the other plans and other in other words, every plan that's applying these same market standard criteria would presumably experience the same level of turnover. Is that fair?
If they're looking at it the same criteria, yes, that could happen, right? If these funds are in their potential platform. Now, again, ERISA World does this on a regular basis, and they make changes, 30, 60 days out typically throughout the calendar year as things make a change. In the non-ERISA world, usually you don't see something like this. It's not something that kind of goes through on a regular basis, or there is a report card or scorecard. It's something Security Benefit has done for a long time that we felt as a best practice that we should adopt similar things to what the ERISA world has in the non-ERISA world. Because there truly isn't, a specific guidelines in the non-ERISA world saying you need to be doing this. But as a best practice, we felt that we wanted to, we call it a investment practice statement, not for investment policy statement. So, to answer that, yes, Lumen Sales, if somebody else has that and are looking at the same similar criteria, and I'm just at the top of the screen here where it says total return 3-year for 6 consecutive quarters, the peer in that global allocation category, they've deviated from what they should be doing.
Right.
And which is that put that. And again, I always say that it's not necessarily means it's a negative. We've had some that outperformed their median in their categories, but that means they're also taking a lot more risk too.
Right.
And you can see some like the news at mid cap value, the 6+ quarters.
Right.
It also has 1 quarter of 5-year, but also 5 quarters of taking more risk than their peers. So that was already, removed out of it as of December 1st, which we'll talk about in a second.
Right.
But yes, to answer that question, if you were in the same boat and it was any particular carrier that was looking at the same type of criteria, they could be going out for that. And you notice that if you're familiar with Morningstar and their star ratings, you start to see some of these that drop in their star ratings because of these things as well. And our goal of this is to make sure we have a well-rounded fund lineup for options and choices for the employees to choose from. And we'll go through that in a minute, but make sure that we don't also have ones that are well underperforming that people are still holding on to that shouldn't be holding on to.
Understood. Yeah, I mean, I've sat on the ERISA committee for a similar function at my firm, and we do go through this several times a year. And I was just wondering if it all made sense if you're applying the same criteria to a menu, because oftentimes it's not so much of actual outright performance. Of course, we all know that is in many ways the bottom line, but participants are often affected by these changes, right? That kind of is, they question it. They don't know, is this a good thing? Oh, well, why is this one getting kicked out? They don't really understand the process. And I'm just wondering if our plan participants see that a great deal, will that cause some measure of unease, if you get my drift? Yeah. And it's a great question because, a lot of times, and we'll show this in a second, I'll go through this and then I'll show the map of where the funds are. But it's also to make sure when you're hiring them as a manager and we're hiring them as a specific category, as a mid-cap, blend or growth or value, that they don't deviate and start and go into somebody else's box, right? We hired them to do their specific job and we want them to do that job and stay in that space. Because if they start to go over, that means obviously there's overlap and things that go on that the participant, not necessarily would know or have, and then maybe get overexposed in a certain area. Perfect. Thank you. So this is a letter, and this is, I should say, a flyer that goes out to every participant as well as employees. It's about 60 days in advance of the December 1st date that they would have gotten this. This is just a notice to say we were going to remove these 3 funds, which we did on December 1st, automatically replace them like with BlackRock High Yield, Allspring Mid Cap, and Invesco Main Street Small Cap, which is the old Oppenheimer funds. Those 3 funds were remapped as of the 1st at the business close, and nothing needed to take place by any employee or participant. They needed to do that. So this just kind of shows you the fund lineup itself, where you have your large, mid, and small, your value, blend, and growth, your others, which are your target date funds, which were both T. Rowe Price and Vanguard that are in here, balance, specialties, global, international, fixed income. The red are the 3 that we removed. So you can see there's other options, of course, available inside of these for them to be able to choose outside of if they didn't want to remap it. After we did it, they can turn around and change. If they didn't want BlackRock High Yield and they want to choose PIMCO, they can do that. Or they could have done it ahead of time if they wanted to. But we gave them that notice roughly around October, early October, that they got this memo out there that we would automatically do that December. And it's
This is done annually. So this isn't something new that we've done. We've been doing this for 10 plus years with the town. That this criteria goes through, and it's typically every December, not necessarily the first, but the 1st or 8th. It's a typical Friday that this happens, that we make these adjustments and changes on the behalf. And I would have to say in the 10 years, Tom, to answer that question too, is typically you don't see a fund that has a lot of assets in it that is being changed. A lot of it has to do with a fund that's been slowly underperforming, and either working with the advisor, you know, Mike and Connecticut Institute of Finance, they've already remapped and reallocated into something else ahead of time, or it's just a fund that hasn't done very well, and there's very little impact to a lot of the portfolio. And again, I'll reiterate, the biggest thing here is also those retirees that tend to sometimes retire early, but leave their money behind. And those that leave their money behind and are doing it themselves, these get remapped and changed even for them, obviously, because they're still part of the plan. And this is just the, you know, the current lineup without the reds on it. You know, one of the things I will point out too is we have a fixed account that I'll go through in a minute instead of a money market that we've always used inside of this plan. Until recently, we've seen the fixed account obviously a lot larger of a yield than a money market account, just because of a low interest rate environment. Currently, that account is sitting at it's a liquid unallocated group fixed account that they can put some money in if you like, as one of the choices, and it sits at a 2.45% rate, liquid rate for them, any employee to utilize. And the guaranteed minimum in the calendar year for 2023, just like 2024, is 1%. So that's the lowest we can change it. And that gets adjusted on a quarterly basis. Nothing changed from last quarter. It stayed the same.
Hi, Phil. This is James. Just got a quick question for you.
Yep.
So over the 10 years on average, how many funds get replaced every year that don't meet the criteria and need to be substituted on average?
Typically, you're seeing it about 3. Sometimes I think the highest we saw was 6. And I'm just trying to think of the last. Most of the time, it's typically between, I would say, 2 and 4 that get replaced on an annual basis.
Okay, great.
You're looking at about 60 different funds here, you know, give or take, that are in the account.
Okay, great. Thank you.
Yep. And then, as I mentioned, this is the fixed account. This is just how our unallocated group fixed account is allocated, with corporates, asset-backed securities, some mortgage-backed securities, some government, you know, cash, utilities, things like that. And as I mentioned, this has stayed the same at 245, excuse me. The others and that have other fees that are part of that, the street level, they call it, is at 215. But the guaranteed minimum that I pointed out for the calendar year is 1%. So each quarter we can make adjustments. Obviously, we've seen that the Fed has paused raising rates, but it all depends on what your corporates and everything else we're able to get. If we need to make an adjustment in those rates and lower them slightly after Q1 or Q2, they're able to do that in an unallocated liquid fixed account, but it can't go lower than 1.
Do you have this is Chris LeBrace. Do you have an idea of the number of participants that are impacted by the fund manager changes?
Yeah, we'll look at that, because that's part of some of the things that I sent over to you. You should see it should have had a breakdown of every participant. There's 292 of them that are allocated inside of here. But it's not a big, in this particular year, there's not much that have been affected or were affected by the last change. I'd have to look at this year's now to see, because we've got 3 that are on the list so far. Those that are on the list, I didn't dive deep enough yet to see how that'll impact, because those things could change. They're just on the list to potentially be removed. But we still got about 10 months to go before we make that decision.
Okay.
These are just the performance I put in there for you to take a look at. Again, these are all through 9/30, because everything's being done through 12/31, since this meeting's just early on into the calendar year of 2024. So this is, and these are going to be similar for both plans, 457 and again, the lineup that we talked about is both for the 457 deferred comp as well as the 401A plan that's out there. The larger of the two plans is the 457 deferred comp. This started back in November 8th of 2013 is when we came on board. To give you a little background, roughly there was about 112 participants that came over from a previous carrier. And now we're sitting at last year we had I think it was 278 or participants, and now we up to 292 currently in participating, which is showing a great improvement, right? The goal of this is a deferred compensation that's offered to be able to help employees save for their own retirement and put some money away. The education part that Connecticut Institute of Finance and Mike and Bob particularly have done has helped educate people to make them aware of, that this opportunity and the plan is available for them to put their own money and save for their future outside of, anything else that they have, which is enormous. To see such a growth over 10 years, I think it's phenomenal to have that many people participating as part of this plan. And that's a testament to everything that not only the committee has done by monitoring and watching these funds and doing what they need to do, but more importantly is just making, Cheryl and Diane and Amy and everybody else that this plan is there and helping them get, notified of it. Government's always getting involved. You're probably well aware of that in Connecticut, how they now require every employer to offer some type of retirement plan if you have more than 15 employees. The state of Maine is rolling one out this year to give you an idea as well for anybody 5 employees or more. So it's a big thing from the Department of Labor to make sure people are saving for retirement. So you've got a lot of different things. The overview of the plan, there's about 17, almost $18 million in assets in the plan. Currently, we've got, as of 9/30, there was 252 active participants with an account balance of roughly 60,000.
Bill, this is Ann Lenz. Can I just ask a quick question? It's more administrative. When you say active, they could be people that have left. Are they active status as active employees or employees that have left and it's a balance left on hand?
Yep. So active employees, unless we are told they're terminated, they have an account balance as an active. And doesn't mean necessarily they're flowing into the contract. When you look at the participants with a balance, that is the balance that we've known that they're terminated and left their money behind. But active, it's a hard question to answer because some people just stop because they have to. They can't afford to do it anymore, but they're still employed. So they still keep their account balance. They're just not participating and adding any new money for the current payroll period, but they can.
Okay. Thank you.
Yep. So you can see there's a slight growth, 246 to 252. And this is just from the end of the year through 9/30. And again, some substantial growth over the last 10 years that have gone on. You've got some quadros in here. You have good sign, right? 27 participants as of end of last year took out some loans. You're down to 25 people that have loans left on their plans. And that's for a variety of different, issues that they've taken out. More demographics. This kind of gets into the root if you really want to dive, and I'm not going to go too much. We don't put anything in compensation in there unless they provide it. So as you can see, there's not much there. Tenure. This is the people that have been with the town for 21 plus years or less than 1 year. What I really like to see is you saw 1 to 5 years, 36% of the participants. There's 91 participants in their first 5 years of been putting in money into the 457 plan. That's a great testament to the education that's been done, by the town and everybody to make sure that the plan is available. This just breaks down your ages and where kind of roughly the age group and where your participants are. You can see you're heavily in between the 40 to 59s, in the age demographics. 31 terminated participants. This is kind of the breakdown then that you can see of who's got assets and where they are roughly, how long they were here and things like that. Now, one thing I will say is a deferred comp 457 plan When you separate from service, especially if you're under 59 and a half, you typically do not have anybody roll out of your plans, because it is one of the few plans and the only plan that allows for anybody at a separation of service to be able to access their money without a 10% penalty. So when somebody leaves and they're 42 years old for whatever reason, or 30 years old, and if they ever run into, I always say, an emergency, and they want to tap into their retirement, they're able to take a withdrawal out of it if they're separated and terminated. And they'll pay taxes, of course, if it's a pre-tax, but they won't have a 10% penalty. Hence why money gets left behind a lot when they're under 59 and a half in a 457 plan, unless they go to another town or municipality that they can transfer their 457. Again, more just details. The average account balance, as I mentioned, is roughly 60,000, which is a lot higher than a typical, retirement account that you see in an ERISA world of a marketplace. And again, where the assets and the average account balances are. And clearly, if you're new, you don't have a large account balance versus somebody that's been in the plan for a long time. Last year, just to give you an idea, total contributions are roughly 1.6 million through 9/30 for the first 9 months. You also had distributions of almost 6 million.
So
A
Phil,
lot of people. Yep.
It's Tom. Just a quick question is I know we try to ask this question, which is a little bit unfair, but it is the kind of reality check that this committee really tries to, engage in at least once a year, which is, in a plan with these attributes, right? 18 million bucks, 290 or so participants, right? Average account balance around 60,000, et cetera, and so forth. Do you find in your market experience that the menu of investment options is appropriate for a plan that size? Meaning, I guess our question as a committee is, do we think that it's too much or too little? Is it so big that it's confusing to people? Or is it not giving them enough options? You know what I'm saying? I'm just trying to get a sense if you, just given what this is, how does that look to you, given what you've seen, other plans that you might, service or clients of yours? You just give us a sense of benchmarking that.
Yeah, it's a great question, right? I mean, it's always the $1 million is what is the right mix, right? At the end of the day, and I know some of you sit on ERISA world of plans and things like that, and a lot in that world is traditionally a lot of target date funds heavily, right? And then you usually have 1 to maybe 2 per category. And forgive me for scrolling back, or actually I'll go here real quick because I can do this to you right here. Traditionally, you only have maybe the index 500 and 1 other blended strategy inside of here, a fund, or vice versa, 1 mid cap value, 1 small cap. That's where the world comes in, and in a non-ERISA world, we feel, and we've always felt this, is the ERISA world sometimes gets a little too tight, because if the fund isn't performing in that category, you're stuck with that until they make those changes, which could be 60 or 90 days. So we kind of expanded a little bit, and you can see there's two to three to that, which gets us around this magic number of about 60. One thing we did a few years ago now, and I want to say it's 4 or 5, is we had an inkling, and a lot of people wanted Vanguard. I know I heard earlier about Vanguard making some changes on your side, but Vanguard we wanted to put in here. But we also heard from a lot of people in our world that said, hey, we love Vanguard, but they're always invested fully in the market. They don't have any manager that kind of like, and I'm picking on T. Rowe here, that says, hey, for a 2045 fund, we want to be a little bit more in cash right now and not put stuff to work. So that's why we left both of them here, which adds quite a bit more funds into it. And we said, look, there is no reason why we should say one's better over the other, because you really look at performances, they're not far off from each other. But if somebody feels that little comfort that they want somebody to say, hey, I want to be a little more cash versus fully invested, then let them be. We're not here to say that which one's right or which one's wrong. So to answer that, yeah, you could have a universe. I mean, obviously there's huge amount, right? At the end of the day, a big brokerage. We felt that this number between 50 and 60 kind of gives you that I would say the sweet spot that gives you just enough of each category where you have an alternative if you want, or something a little different than just an index fund. And then also by doubling up basically your target date funds, it adds a lot, quite a bit more.
Thank you.
So And so Tom, a couple things with that, right? We have the target date funds. We have the Connecticut Institute of Finance, excuse me, that are willing to sit down with somebody if they do want to sit down and talk about this. We also offer a portfolio that Mesero is designed if they want as well, based on their risk category that they could fill out, which is some of the, a category of these funds too.
Right. We're just trying to view this all from a
Yep.
plan participant's perspective. And are we making this as user friendly as we can? Are we confusing them? Or is this kind of right what they need? And so that was helpful. Thank you.
So
Yeah,
Tom, sorry, Phil, it's Deanna.
Yep.
Because I just entered this plan as a participant, being elected, and someone whose husband is a pension fund manager or formerly a pension fund manager. And I felt like the options were way too many. And, my daughter's in the pension consulting business, or in the, and when I showed her our list, she's like, oh my gosh, I've never seen so many. So I and I'm financially astute, and my husband helped me go through it because he's even more financially astute than I am. I thought the offerings were immense. And I mean, I commented on it to Cheryl when I came in after I had gone through it, because, I'm fairly financially sophisticated, and I was like, wow, there are a lot of options here.
yeah, I guess if
one person who, recently went through this.
no, I appreciate the feedback, right? At the end of the day, I guess, everybody's, you got 8,000 different mutual funds out there, right? To choose from. And one of the things, again, it's an optional program. We don't want to put it as a cookie cutter and say, these are the only 17 options you can have, being that it's a non-ERISA plan. So we try to make sure that there's enough diversification and choices to choose from. That's where a lot of times people that are just getting in will choose maybe a target date or a model portfolio or other options that you have in here. If we want to try to narrow this down, that's something, if the committee really wants to do, we could do that. I'm just not a fan in a non-ERISA world to make it as strict as possible. That really hampers your aspect. Because remember, unlike the ERISA world or the pension market, where you're doing things on a daily basis and making those changes, in the non-ERISA world, you don't quickly make a lot of changes. Meaning if you only had one fund, you're not making changes on a regular basis. And I don't know many in a 457 world that make changes at all in that space.
Phil, this is Colin Dalvin. I have a question. Are the offerings of the funds that our town offers to its employees the same that your other clients are being offered? Is it the same bundle of choices, or are they unique to each town?
Nope, it's the same for our 457 deferred comp. It's the same for each one.
Okay. One other question I had. I assume there's no matching contributions. I saw something on one of it. I was just wondering, do municipal governments ever offer matching contributions or not? And what's the status of that?
So on this, there actually is matching for the newer hires that are not part of the pension plan. They get a match into the 401A, which is why there are two separate plans.
Right.
Oh.
Right, because I have a match.
Okay.
I have one too.
Yeah, on page 5 of the plan features, it says matching contributions not offered, but 88.2% is the benchmark. So I was wondering who's in the benchmark. Is it only?
So the 457s, the matching doesn't go into the 457 because the IRS rules on it is that the limit is a hard limit. Like on the 401k side, you can go above the limit with your matching, but the 457, it's a hard ceiling, it's a hard cap. So any matching goes into the 401A. So the 457 won't show the matching because it doesn't go into that particular plan, but it goes into the 401A, which is considered the matching part because that's the town's money contributed for the participant.
Thanks for clarifying that for me.
You're welcome.
Yeah, the way the Department of Labor put in the 457s is employer and employee contributions in a 457 count toward the full limit of 23.5. Unfortunately, that's why the match on employer money goes into the 401A, so it can keep it separate, so an employee can do the full 23.5 that they need for their own, plus age 50 catch up. Unlike a 401K that you can have employer and employee contributions all in the same plan.
Thanks.
Yep. So you have to go through some of this with the participants, right? The average number of investments is about 4.8 that people have in their portfolio. There's 123 participants that are invested in a target date fund in there. And this just kind of breaks down for you a little bit by participants. The total participants, as I mentioned, that's including the ones that have separated but left their money here, by age and how they're allocated their portfolio roughly.
Hi, Phil, is there a way, this is James, is there a way to kind of, I guess you can tell from the breakout, if the participants are really only investing in primarily one fund in each category, as opposed to evenly distributed? So that might be able to cut down some of the number, because I have a tendency to agree with Deanna that 60 seems like a lot. I mean, I'm just looking at my recent statement, and I don't think I have 60, and we have a pretty big, I mean, it's just a regular plan with a company, but I mean, it seems like there's a lot. Like, for instance, if there's a target date, whatever 2030 is pretty much everybody just in the T. Rowe Price because it's first on the list. And how different are those two funds anyway?
Well, yeah, I mean, we're not here to dive too deep
Yeah.
into each one, but right, the T. Rowe Price is like a high level mention is one that's going to be more actively managed and has cash positions in their portfolios, bonds and stocks, right? And the Vanguard is going to do something similar, except they're fully invested traditionally in the markets. And that's why we offered both of those. And you're looking at right there, roughly about 22, 23 funds just in those target dates, in those categories.
Yeah, I was just wondering if everybody pretty much just, they retire 2030, so they're just going to pick the first one on the list. They'll go to the T. Rowe Price 2030, and that'll be it.
Let's see if I can,
No, I mean, it's just not that important. I mean, I'm just curious if, on a way to kind of cut down some of the, it can be a little daunting to have 60 different choices to choose from.
Yep. No, we don't disagree.
Phil, does it impact the fee structure to the participant by having so many offerings? Like the if we had fewer offerings, would the I mean, I know there's the fees that the investment company charges for their fund, but for your management or whatever of the program, would we be able to cut down on some of the expense related to if we had a fewer offerings?
No, it does not. Because again, like I think Colm asked earlier, this is the platform we offer for all of our deferred 457 plans that have this. So everybody has these options, whether they use them all or not. As you can see, there's some of them that don't even use, you got a Vanguard Real Estate that has one person in it, right? At the end of the day. And that's is one of the biggest challenges too, is you don't want to have too little, because we run into this in the ERISA world space, that there's 21 offerings, 11 target date funds, and 10 others. And some people don't participate or just do enough to get the match because they don't have they don't feel they have some of the best options available. So they go outside and do IRAs and some other things, right? So you're stuck in I always say the quandary of how well do you and how closely do you want to manage, and how small do you want to do it? Or do you want to kind of give them a bigger, and I'll go back just so you can see it. Do you want to have at least one or two choices per category? And you got to remember, you got 9 categories just in the large, mid, and small space, let alone your international and global and things like that. And some don't even offer a global bond or an emerging market in some of their 401ks. So we try to make sure each category is represented, so people can, diversify their assets if they want, complement some of the other things that they do. And it's similar, I'm not going to go through all of this in the interest of time. I know a few people got to jump off, so I want to make sure we have some Q&A that we're doing now. But the 401A plan is a much smaller plan because it is the match going in for those that are not contributing into the pension. In 2022, you're looking at 2.4 and 2.8 million as of 9/30 with 168 participants. Again, this is going to be a smaller account average balance because, again, this is their match side of it that's going in. But they're the same fine lineup, the same everything else that's in there. And you can see 1 to 5 years as being your biggest, mostly half of the employees are sitting in that demographic and the first 5-year tenure. Not necessarily age, first 1 through 5 year.
Bill, can I just, this is Ann Lenz. Between the two participants, one was in the 100s and the other is in the 200s, which I'm assuming are either retired or just left their money there because they're not getting the match. I wouldn't understand why they wouldn't want to get the match on it. Is that differential people we're carrying that have moved on, retired or gone to another, left the town?
Are you talking about the active participants?
Yeah, so this number is
Yeah.
168 on the matching report. On the contribution, which is the employee side, was 200 and something. So I would have assumed that numbers would be close other than people that have left the town, but it seems different.
It's different because some people participate in your pension plan and some people do not.
Oh, but they can participate in the 457, but not in the matching.
That's correct.
Got it. Okay. I didn't know if that was retirees and is that quite a carrying cost to hold on to people that are no longer with the town? Okay, understood. Thank you.
Yep.
Is it also people like me who don't get the pension and just participate in the 401A? Am I misunderstanding?
You would be in both.
You'd
Yeah.
be in both. Yeah, you'd be in
Okay.
both.
Yeah,
Meaning-
the 457 is any employee can participate in the 457 plan that basically gets a paycheck that's by the town. So you're able to participate in that. Then it becomes now we sit down and say who is eligible for the pension, who's not eligible, and who can participate. And that's where that splitting of it goes for your numbers that you're looking at.
Perfect.
And again, some of these we don't, if they answer the gender male or female and their things, we have those in there. Otherwise, they're not provided. But I'm not going to go through a lot of this. I mean, you can see, you're going to see a lot of the same things with the demographics. You have this information as well.
Well, good.
Anything
Well,
else?
this all sounds pretty good to me. I would just say for Coleman, James, and Chris, maybe this is a good fruit for another agenda, later in the year to talk a little bit about just benchmarking the menu of choices and getting a sense, maybe Michael and his team has some feedback about, relatively speaking, how confusing it is, how helpful the flexibility of having such a wide array of choices is or can be to plan participants. I can imagine a lot of people go to one of those target date funds, they enjoy or the appeal of the set it and forget it aspects of those things. And that all makes some sense to me, but it does make some sense, I think, for us for an agenda for a later meeting. Let's look into that a little bit. We can also look into some of the other features and, again, within the realm of what's possible. I noticed some Roth conversion. Is that available or not? If not, why not? And that kind of stuff. And I think that's all good fruit for another agenda later in the year.
Tom, I think what might be helpful for future discussion would be a chart that would show how many participants have invested in each fund, recognizing the fact that there might be that the participants invest in many different funds. Oh, you already have that.
Yep, there's your number of participants in like the Vanguard 500. You got, this is in the 457, have 34 participants.
Okay.
Opening balances, your contributions, any fees that are associated with withdrawals coming out, gains, that kind of thing in your closing balance from 9/30. And this is done on a quarterly basis.
Mhm.
I would say
So this
too,
is
just
helpful because I think this shows you where the interests lie
Yeah.
amongst the participants.
I would
We
say
should
just
probably
looking
look
at
at this, probably dive into this a little bit and think about it some.
Yeah.
Yeah, and I would say just looking at this sheet, kind of like just top off the head, it looks like the T. Rowe Price target date funds have between 3.5 and 4 million, where the Vanguard target date funds, I don't even think accumulates like $250,000. So that could be, if this is something you guys do want to explore, that could be one easy avenue just to get rid of some funds. The Vanguard ones are hardly being used, at least on the, target date funds side.
Yeah, that all
Yeah.
sounds. And I don't know, Michael, if you have any way of sort of accumulating the sort of anecdotal feedback of, the questions your teams are fielding about this stuff and whether or not participants, if they have a lot of confusion or they like having the flexibility of such a wide array of choices or whatnot, there's some way that perhaps we can dive into that a little bit,
Yeah, generally speaking, I don't get feedback on the funds from the participants because the people that are engaging me and that I'm dealing with,
Yeah.
they're coming to speak with me, and they're pretty frequently meeting me on a quarterly basis, either in
Yeah.
New Canaan when I'm there or coming to my office. And I'm, we're having discussions and I'm choosing the funds for them.
I see.
So the people that I interact with, they have no issues with the fund lineup because they're not making any decisions on it. They don't know any of it, so they're taking advantage of the services that we offer. And I mean, me personally, of course, as a advisor and someone that does manage portfolios, I like having the extended lineup of it because it gives me more options, and it makes things a little bit better for me to kind of be more specific on how I'm allocating a portfolio for people based on their risk tolerance. But aside from that, I've before tonight, I have not received any feedback from participants or anything of that nature that there's too many choices within the fund lineup. I mean, that sentiment very much may be there. It just has not come to me prior to this meeting.
Understood. But I think it seems like it's worth exploring for sure.
Yeah, I was going to chip. I worked for two major corporations over 32 years, and I always heard the opposite complaint, that there weren't enough choices. That in the 401ks anyway, that the participants would have liked more choices like this. Now, I understand when you get to a certain number, it can be confusing for people, but the complaints I always heard were the opposite. It would have been nice to have more choices.
Yeah, that's my experience as well in the private sector.
Yeah, and that's what I was going to say. And that's why, if I go back to it real quick, sorry, is when you look at the fund lineup, as I mentioned, that's why we have one or two in each category for that exact reason, because we still hear it in the ERISA world, because a lot of times it's just the target date funds and a couple up here, and they're left with about 21 different funds, and they wish they had more. Your largest holding, just to give you an idea, is the T. Rowe Price 2045. Currently, it's sitting at 2.25 million. As a closing balance, this is 930, and you got 30 participants that are holding that. And that's obviously the retirement year that they're in there. But when you look at the allocation of the percentage of people, you have 95 people holding the T. Rowe Price growth stock.
Yeah.
Balance of 1.7. And that's your second largest holding. It's over 2 million now.
I'm just curious, Phil, if you added up all the number of participants across, you should be able to find an average of your average employee, how many funds they're in, right? Like 2.3 funds or 3 funds or 5 funds, right?
4.8.
4.8. Okay, great.
It's right here on the
great.
slide 16. 4.8. With 123 of the total participants, you got 123 just using target date, and the average for the rest of them are 4.8.
Oh, okay. So about half of them are just using the target date.
Yeah. So you got 31% using one investment, which is a target date. 11% of the participants are using one investment, which is a non-target date. 8% of your participants are using 2 different types of investments.
Right.
2% are only using 3, 3% are using 4, and 45%, almost half, are using 5+ investments, meaning they're holding those 5 or 6 different, funds in there. So, you know, when you look at this, 76% are either using a target date or allocating themselves or working with Connecticut Institute of Finance and creating a portfolio in a lot of cases, unless they're doing it themselves. But if they're not, a lot of times maybe they're just holding, and I'm just picking funds, a Vanguard 500 and a total bond market, you know, something in the 2 investments or something like that.
Interesting.
Yeah. Okay. Well, good. Anything else from any of the committee members for our presenters?
No, I thought it was very comprehensive and educational.
Yeah, and I thought the materials were well done, so thank you for that.
You're welcome. We appreciate the time, appreciate everything that we've continued to do. Like I said, if you want to explore more, please let us know. You know.
Yeah, for sure. We'll get with Diane and Cheryl and see if we can't get you all on the agenda in the coming months, and maybe look into some of these questions we've unearthed a little bit further. But thanks so much, Phil and Michael. We appreciate it.
Thank you.
Thank you.
Okay.
Thank you.
So let's see here. Squinting at my screen. Well, there he is, Brian.
Brian is here. Brian's already on, so if you want to move to the next agenda item.
Yes, so we're now going to switch gears here as we do and go to the defined benefits plan. We have the pension, the OPEB, and the Marsley Scholarship Fund, and there's Brian. I see you here. You're in my bottom right corner.
Yeah. Good evening, everyone.
Hi, Brian.
So yeah, and so Brian, Diane has shared your presentation material, so we have your presentation on our tablets. But if you want to share your screen through it,
Sure. Let me do that. Let's see. Did it come up?
Yeah.
Yes.
Yeah.
Mhm.
Okay. If I minimize it a little bit like this, does it shrink it on your side?
Yeah, a bit. I think I see
All
some
right.
gray margins. Yeah.
So this is maximized on my screen. Just when I do that, I only have one monitor. I can't see you. So if this is better, I'll keep this view.
Yeah, this works so far.
Okay. Okay. So good evening. I know we're kind of all remote. Tom, I hope you feel better soon. Given just everything that's going on with the transition with Mercer, where would it be good to start? Should I do a quick review, just kind of and then leave plenty of time for questions? How would you like me to go through the presentation?
Yeah, I mean, I think we have your presentation. I think you should probably spend, 5 or 10 minutes walking us through it. I mean, we had a bit of a head scratching year with, the last 6 weeks being monster 6 weeks. And so, kind of walk us through how that all manifested itself in these 3 funds and the investments and
Okay.
rebalancing or whatever. And then we can talk about where we sit, what the numbers look like, to just kind of the basic fundamental numerical stuff about, well, as we begin to think about ADEC and other sorts of things.
Okay, perfect. Thank you, Tom. So I organized the presentation here on page 2 as far as the agenda, kind of just to hit some key parts that might help you now and then going forward, and we could have other updates throughout the year. But so one is I included everything in here for the performance review for all 3 funds as we usually do. So I'll hit that at a high level. Talk about the estimated return of assets. So I updated that using our most recent capital market assumptions.
Yeah.
And then I also included fee analysis as a way to give you updated numbers for when you're out there, soliciting new bids. So to provide some information, and always in the back, just some context of the 3 funds that we have. Does that sound like a good kind of overview?
Yeah.
Okay. And all the material that I have starting on page 4 here is through the end of November. The December performance reports will probably be out here the mid to the end of the week. They usually come out business day 8. So we'll have that through December, and I don't mind writing up a brief email. That's how it, if it helps the committee. So just here on page 4, and this will help us when we get to the performance of the 3 plans, is yes, it was a very strong year. It ended, a lot of the gains came in the kind of the final couple of months. We had a lot of volatility, if you remember, failures of Silicon Valley Bank and others in the beginning of the year seemed like a distant memory. And it's really been all about what is the Fed doing or expected to do. And some of the easing of inflation and the indication that they're kind of done with hikes, caused the markets, the equity markets to rally towards the end of the year, as well as help the bond market. And that's what's summarized here on page 4. So through November, you have U.S. stocks up an astounding 19.6%. And I say astounding because coming into the year, and Vanguard included, most economists, most forecasters were predicting recession. So great, another example of not trying to time the market. So you have U.S. stocks up 19.6, and then non-U.S. stocks also up double digits, 10.1%. If I carry those numbers to the end of the year, just for the major indices, that's not on this page, the U.S. market ended up 26%, and international stocks was up 15%. So extremely strong gains, and that's welcome given last year was kind of the reverse of that. Right in the middle, if we're looking at fixed income, we hold U.S. bonds. This is the Bloomberg Barclays aggregate. So through November, U.S. bonds or fixed income was up 1.8%. But we saw interest rates for the longer duration bonds come down further in December. So the U.S. aggregate finished up 5.4%. And it was negative through October. So again, a really strong rebound that happened in a short period of time. And that was welcome to have fixed income have positive gains. So looking at that, through on the right-hand side of the page, this is not your portfolio, but a balanced 60-40 portfolio through November was 10.6%. But if I updated that through the end of December, it's a 15.8%. So very strong gains to end the year. I'll go through, I included a lot of additional context, just again, in light of everything that's happening, but I'll go through some of these pages for context more briefly. When you look across the spectrum, the gains in the equity market was largely due to large cap stocks and growth stocks. But if you combine those together, that is really some of what was like dubbed the Magnificent Seven. So if I go to the next page on page 6, information technology, communication services, consumer discretionary, you could see how big those gains were on a year-to-date basis. So information technology, think, your Apples, communication services, certainly Google, et cetera, gets thrown in there, and consumer discretionary stocks like Tesla and Amazon fall into that sector. So what I'm getting at is a lot of the gains were still in that tech broadly defined names, and also those happen to be large cap. So going back here, that's why there was gains across the cap spectrum, but most of that happened with large cap growth stocks. And then with regards to the fixed income markets here on page 7, again, I talked about those all being positive, even high yield, which isn't in the portfolio. If there was more of a consensus that there might be a soft landing, that bode well for any kind of riskier assets, including, say, high yield here. But still, if you have long-term fixed income, which we do not in the portfolio, you saw negative gains. So just taking a pause there, I'll jump into the actual portfolio for the three plans. So starting with the pension plan, again, through November on a net basis, so 10.15% on a gross basis, after Vanguard's advisory fees, 11.08%. So double-digit gains on the calendar year. That I would expect, of course, to be higher through December. I talked about a 60-40 portfolio returning around 15.8. So I'd imagine it'd be somewhere in that ballpark. Page 10 and 11 look at the three funds that we have, and these, for all intents and purposes, kind of mirror the returns that I just talked about. Total stock market index, the total international stock market fund. Those are the indices that I just showed on the previous page. So those returns will follow that. And same with on page 11, the total bond market index follows what I just talked about on the previous pages as far as the year-to-date numbers. What I included some additional slides that you don't usually see because they don't usually cover annual periods. But again, I did include it just to give the committee more information as you're preparing for RFP or talking to other vendors, that shows the annual years and since inception returns. So just in context of the returns that we're talking about, you see 2022, we had a big down year with the equity market sagging, fixed income negative. All the public markets were really negative in 2022. But that longer term since inception return that goes back about, almost 20 years, a strong 7.16 or 7.2%, and that's been higher than the discount rate. I also included, which I'm on page 13, but this is in here for all of the funds. I included the benchmark allocations over, through history, going back to 2002. So you'll have that in the performance reports, but if you ever need to reference it or question how has our portfolio changed over time, I included this benchmark allocation history for all of the plans. So I covered the pension at a high level. Here's the OPEB plan at a high level. The asset allocation is the same. The performance never mirrors each other because there's different cash flows. Mainly, most of the cash flows take place in the pension plan as opposed to the OPEB plan. But this return on a year-to-date basis, slightly higher than the pension. So on a net basis, 11.39%. Without flipping back again, on a net basis, it was 11.08 for the pension. So very close, but some discrepancy just because of cash flows between OPEB and pension plan. Same investments, same history I included. And then if I went to page 19, this is the Mildred Marsley Scholarship Fund. The asset allocation is slightly more aggressive, meaning it's 2/3 equities, 1/3 fixed income. So you'd expect a slightly higher return, and that's what happened. So on a net basis, 11.87 absolute return on a net basis. Also included the benchmark the annual returns for the last 10 years and the benchmark history for that.
And for OPEB and the Marsley Scholarship, your back of the envelope add in December would also yield that approximate 15% return.
Yes, exactly. Yeah, in that ballpark, exactly right, Tom.
Okay.
So before I hit the other sections, I know that's a quick overview, but certainly strong absolute returns to the town to be happy about.
Yeah. Anything for Brian on this part so far? You okay? So let's keep diving.
Okay. Yeah. So going to, we like to update this. We don't always look at it every quarter, but I wanted to include the most recent forecast using Vanguard's capital market assumptions as of the end of the third quarter. So just as a reminder of what this looks at, it looks at our target allocation. This is for both the pension and OPEB. So, excuse me, you see our target allocation to US equities, non-US equities, and fixed income. To the right of these target allocation, these are our 30-year forecast for the asset classes. So say we expect US equities to return 6.4% at the median. We provide the whole distribution.
Right.
So using that in correlations, our expected return for the pension and OPEB over a 30-year time horizon, which the actuary uses, 6.82%. And here's the distribution that we look at, the return distribution, but at the median, 6.82%. The current discount rate for the town is at 6.625. So thinking about that, like within a return distribution between our 25th and 75th percentile, certainly that is conservative and well within that range. Yeah, I included a 10-year look just for some data for the committee, but it's really the 30-year that the actuary is focused on. Right. But even a 10-year time horizon, slightly lowered at 6.29% at the median. But as you look longer term, and that's because some of the valuations, particularly in the U.S. equity market, are higher than overseas, and that's why if you looked at our forecast for the asset classes, you see a higher expected return for non-U.S. equities versus U.S. equities. This has been several years now, and it's just really reflecting the higher valuations of the U.S. market. So that's for both the pension and the OPEB. Any questions on those particular data?
No, I mean, you might recall, Brian, that it was just last year that we reset that discount rate. I think we trimmed 12.5 basis points. There was an opportunity to do so. It wasn't that painful of a decision given other circumstances, and so we just kind of follow that trend and kind of give ourselves a little bit more cover because it just seemed like the right thing to do.
Yeah, totally makes sense.
Good.
So going back into the presentation, again, just to help as the town moves forward, on page 28, I put in the Vanguard's advisory fees, but I also included how the fund expenses look. But it's really this top schedule. Most OCIO providers, Vanguard included, use kind of an asset weighted fee schedule, so different tiers. As your assets grow, the percentage comes down. But this 178 million reflects, we're looking across all three plans. We're aggregating assets across the three portfolios. So that's what the 178 million reflects. And then based on the different tier structure, the town is currently paying 6.1 basis points or 0.016% on a dollar value. That's 108,000. This is an annual basis.
Yeah.
We like to show, so that's what we call as like an out-of-pocket expense. We like to show all-in fees. So here are the three funds that are utilized by the town in the portfolios. You see that the fund expense ratio for each, 3 basis points, 8 basis points, 3.5 basis points. So very low. So on a weighted average basis, the fund expense ratio is 4.3 basis points. So extremely low. This 77,000 just gives you an idea of what that would be on a dollar basis, but it doesn't come out of the portfolio. That's really reflected in the fund performance. So I don't want you to think that the town is paying for that, that just comes out of the fund performance. And as you know, these funds track their benchmarks extremely closely.
Right.
There are two other services and thus fees that Vanguard provides on behalf of the town. Serves as a trustee, and then does also the pension payroll. And you see, the basis points and the dollar value for those services.
And so, and those, Brian, in addition to the, the 108,000 on the investment side, which I get is
right,
managing the investment portfolio, rebalancing, these kinds of reports, all that kind of stuff. But
yes.
In terms of the trustee fee, is that simply establishing and maintaining these three accounts at Vanguard, right? And then the payroll pension is helping us with the paperwork for beneficiaries who are withdrawing from the plan, right? You help.
Yes, and actually making those payments to those beneficiaries.
Okay.
Do we actually make a payment to Vanguard for those as opposed to fees coming out? You mentioned that the management fees are reflected in the overall performance, but for
Right.
the trustee fee and the pension payroll fee, is that paid by the town directly to Vanguard, or how is that payment made?
Yes, directly to Vanguard. And what I don't recall is, for a lot of clients, those are deducted out of the trust on a quarterly basis. So I don't recall, or maybe Diane does, I don't know if there's let's call a physical ACH or check, or if it's just automatically deducted from the trust. But yes, it's being paid by the town.
Mm-hmm.
Yeah, but I don't, and maybe Diane, we can check that ourselves, but I wouldn't expect it, Colin, to be an obligation of the town. I think the fund is, right?
Yeah, that's what I was getting at. But
yeah.
It gets charged to the
Huh.
to like the pension plan. It gets deducted just automatically.
Yeah.
Got
Those
it.
bottom three come out every quarter. The
Okay.
timing's a little different on each, but
Mhm.
it comes out directly.
Yeah, and paid by the trust,
Correct,
not
by the trust, not the town. The town doesn't
not
make
the
it.
town.
Yeah.
right.
Correct.
Okay, thank you.
And then I have information about the funds. I usually put that for informational purposes.
Yeah.
Yeah. So let me pause there, and I think there may be, or how can I help with broader questions about everything that is happening. And then Diane, let me know, should I just update the RPAC with regards to some information we got on Friday about from a particular third party?
Right, well,
Why don't we do this? So yeah, so there's a couple things there to unpack, or whatever your favorite phrase is. But so just so the committee has the benefit of your kind of market intelligence,
Mhm.
before we dive into the RFP and trying to transition these
Yeah.
services to a new provider, can you let us know, in your experience, have you seen other peer communities also trimming their discount rates, or do you?
Yeah. Okay. Yeah. Sorry, I didn't want to move on too fast from that. So thank you, Tom. Up until last year, then yes, that was the common trend for any of the public funds that I work with, but also within the industry. And there's some bigger reports on public funds that kind of show that. I think that at the state level, they tend to have a higher discount rate and reduced it on a slower basis than municipalities.
Yeah.
But yes, until really the end of this year, plans were reducing their discount rate.
Yeah.
No question about it, because capital market expectations, given that the strong returns of the last few years made equity valuations. But what really changed, the biggest change in the last 12 to 18 months, is that fixed income interest rates are now at a much higher level than they were 12, 18 months ago. where I'm going with this is that fixed income is actually showing like, you can make a pretty decent return now from fixed income. And that wasn't the case before. And so if I rewind again, 12 months ago, you had high equity valuations and fixed income interest rates were still 1-2% or less, depending which time period you have. And so plans were reducing the discount rate. I think that you'll see that stop now. I don't think you'll see plans further reducing unless that they were artificially high, say above 7%, and they just really didn't get around to reducing. So I think the pressure is off there to reduce the discount rate any further.
Yeah. Right.
At the same time, I don't think you'll see plans now reversing course and increasing the discount rate. I think for the most part, plans will keep the discount where it is.
Right. I mean, I think, committees such as ours, kind of now more fully appreciate the conundrum of having it too high and how are we going to take it down, and to do that in a measured and, gradual way. And I think with, this calendar year's strong ending and performance, I think we enjoy the benefit of, having your sort of benchmark return on assets as being, somewhat above where our, at least for the whole three, if you had to blend all three funds, it's somewhat above where our discount rate is. Like there's no benefit in being a great deal lower, but it is some measure of comfort to have it somewhat, below where we were. So I think that's very, very helpful.
Right. Right.
So, maybe now it makes some sense to move on to the more transition type topics. I think the committee members know or are aware of the fact that Vanguard has entered into an agreement with Mercer, and this line of business is being acquired by Mercer, and Mercer does not intend to continue that portion of the business that services public clients such as, the town of New Canaan. And so we have to go out and find replacement service providers for all three services that Brian just referred to when he was discussing the fee breakdown. And so Brian and I have had a couple of conversations, or at least one conversation, have been exchanging some stuff by email. I know he's had, kind of many conversations with Ann and Cheryl and Diane and whatnot. And, the committee members should just know Brian's been extremely helpful in walking us through this, et cetera, and so forth. I think we have prepared a form RFP. Maybe Cheryl can talk about that in a second and where that is. But the idea is to go out, request certain proposals. There will then be a need to review the bids that we get in from the service providers, winnow those bids down to some finalists, and to agree a process to work through those finalists, interview some of the personnel and managers from those finalist bidders, and then make some decisions on what we're going to do. One of the wrinkles or complications we became aware of is that many of the service providers in this field or in this area, and particularly when you analyze which firms provide these services for many of our neighboring peer communities, many of these service providers do not provide all three services. They'll provide the investment portfolio part, but they don't have the capacity or the back office or the size of Vanguard to provide some of these other services. And so it's, I suppose it's fair to say it's not unusual that certain towns, pick on Fairfield or whatever, they have these three service needs, but they don't have one-stop shopping the way we've enjoyed with Vanguard for the last 10, 15 years or longer, I think, actually, right? So in any event, the RFP is in place, and Brian's been working with us to help with the transition. And maybe with that, I don't know if Cheryl, if you want to talk a little bit about where we are with the RFP and what
Sure. First of all, Brian, I want to thank you. I'm sorry I came in late. I had a daughter who was sick. With the RFP, Tom has been very helpful. We've been back and forth putting documents together. Right now, it sits with Lori, who is our pension attorney. She is making those final changes. And then I'm going to have Brian take one last look at it, and then we should be good to go out. So we're in good shape. Of course, it happened over the holidays, which delayed us a little bit, but we should hopefully be out with an RFP, I would hope, by a week from now.
And Cheryl, can you maybe walk the committee members through, how we've assembled at least the perceived universe of bidders that we're going to send it to? And whatnot?
Well, what we've done is reached out to all the area towns. We've also, I think Diane and Ann can say we've had many individuals reach out to us. What I have told Diane and Ann is that we're not really speaking to anybody. We're just telling them that we will send the RFP to them. And then once they come forward, the committee will decide with who they want to meet with. So we probably have, I would say, 10 different groups. I think, as Tom said, some can handle the whole thing, and others we would have to split it up. So we do have a good group of individuals out there and agencies that want to bid on this.
The other thing you might be curious about, you being the other committee members, is what's the timing?
Yeah.
That's been the $160 million question. Since we've learned of this, and to be perfectly honest, we have taken the position that it's going to take as long as it takes. We will move with a continuous level of diligence on this.
Right.
It can only take as long as it's going to take, and we're going to move, etc. And Brian and his team have been very good about voicing that view to the higher ups at Vanguard and Mercer, for that matter, saying, hey, look,
Right.
exit this. I mean, we don't need to point to termination provisions and contracts to get into that. Just, we get it. We don't want to be a problem. We're not saying we need until the 4th of July to do this. But on the other hand, this thing is not happening at the end of January. So we kind of conveyed those. We've gotten some, what's the right phrase, Cheryl? We've gotten some measure of comfort back in terms of, we don't have a solid date, like, oh yeah, don't worry, take till Memorial Day. We haven't gotten any. On the other hand,
Brian has been good with that.
yeah, they have been very understanding on that messaging, which is good. And as long as we keep on this, I don't imagine that the timing is going to be a problem. One man's view, but I mean, that's kind of where we come out on this. I think one of the suggestions, a very helpful suggestion, was that in our RFP, we are going to ask bidders if they could commit to a date by which they could be up and running and operational, so that we know what they feel is the timeline they need to transition the accounts and to get up to speed and get everything that they need. And so I think that will be very good market intelligence that we can then bounce off different people and say, hey, does this seem realistic? Or do people, and does that seem wise? It's fine or whatnot. So we'll be able to kind of check some of those things. But I thought that was a good feature to put into the RFP, sort of a transition target, and by which, and what do they have to do, and what are their assumptions in coming up with those dates to see how realistic they are.
Yeah, and the thing that works in the town's favor is certainly the liquid nature of the investments, right? We don't have any alternatives in the portfolio. That adds another wrinkle with providers. So you have public asset classes, mutual funds. They could easily be transferred in kind. I mean, any other provider may say, okay, yes, we have our own different asset allocation we propose, or funds, etc. But absent that, the funds could be transferred in kind, and that process should be really quick, I think. So the deadlines that that we're working with out there is, we don't know when the deal will close between Vanguard and Mercer. It's expected to close, by the end of the first quarter.
Yeah.
I mean, there could be extenuating circumstances, but the close is supposed to happen in the first quarter. And then from there, all of our clients will have 90 days post the close. That's how it's been communicated.
Oh, good.
For the time being.
Yeah. So they are committing more or less to a hard date. I was unaware of that.
Yeah, 90 days post close, but we don't know when that closing date is. Now that's for the advisory services, right?
Yeah,
For the pension payroll, they realize that's a whole different service with its own complications, right, and intricacies. So for pension payroll services, it's 12 months post close. I mean, you don't want ever be in a position where someone's not receiving their check. So the pension payroll services is 12 months, post close. So it could be one provider, certainly that probably make it easier for the town, but may be two providers. There's a different timeline for that. Trustee services is something that should be relatively easy for whatever provider it is, right? It's more the pension payroll. It's probably the most complicated of the services.
Yeah.
So yeah, that's the timeline around. We're talking about, like, deadlines. If anything changes, extensions happen, I'll certainly let the committee know. There was one other thing that I wanted to bring everyone's attention that just happened late on Friday. Before I get into that, is there any question around anything I just said?
Yeah, how quickly are people being asked to respond to the RFPs?
That I don't know. I haven't been on all of the RFPs that have gone out. Like I know one town, like for instance, town of Greenwich has already went out to RFP, and I believe that they set a deadline towards the end of January. Now they were out to bid more recently, so it was a little bit easier for them. Like it was only about 2 or so years ago. So they were able to turn something around quicker.
But they're
towns have
giving,
not gone out to RFP yet.
so they're giving bidders, like, call it 3 weeks.
Right.
I mean,
yeah, I don't know when the RFP got posted, and I can go back to see what the date is, but yeah, about 3 weeks.
Yeah, our attorney was recommending anywhere from 3 to 4 weeks.
Yeah.
And I think for the committee members, we're still, Cheryl and Diane, and they've included me in some of these conversations. They're still working with Deanna, because we do need to figure out, not only get all these bids, how to digest all that information, right? We're
Correct.
gonna, slice and dice it and put it in charts, and we're going to figure out, well, what did this bidder say about this issue or this fee, or whatever it is. So we have to do all that. And then what other parts or arms of the town legitimately have an interest in at least participating in winnowing this thing down?
Correct. The board of ed being a big.
Yeah. So the board of ed has many non-teacher employees involved in these funds, and so we think it's only fair that they have a representative that helps us cull through all the information and engage in the conversations, and kind of involve themselves in the decision making of who the finalists are, and that kind of a thing. I mean, I think at the end of the day, we are a subcommittee of the Board of Finance, and I think again, we would be fine. But I do think there is at least there's a political aspect to this, which makes perfect sense to me, that we should be including or inviting someone to at least to sit in and have their voices heard, and get themselves involved in that kind of thing. And I think Deanna was going to reach out to Brian to figure out who or what was sensible under the circumstances. Is that about right, Cheryl?
Yes, I spoke to him yesterday, and he will be putting a name forward tomorrow.
Yeah, that sounds perfect. So we're going to need, and then in the coming 3-4 weeks, to figure out, once we get that name, and we can work with Diana and Cheryl and figure out how we as a committee want to involve ourselves in pulling that information together, or winning it down to finalists, and then interviewing people from those finalists, so as to enable us to make a decision in the February-March timeframe.
Tom, can I jump in and add something?
Sure.
So late on Friday afternoon, we got some information because this has put all of our public fund clients, kind of in a really tough position to put it mildly, and so this information about Mercer acquiring Vanguard's business happened kind of right before the holidays, so it became public, and we New Canaan's probably not alone. I'm sure other firms that do OCIO reach out to the town. Well, where I'm going with this is there is an organization referred to as PFM Asset Management. They're based in Philadelphia, but they have offices everywhere, and they serve the public marketplace. They have a lot of public clients. So this organization, PFM Asset Management, approached Vanguard because they knew. So the reason this is all happening is Mercer does not serve public fund clients. And that's why this whole thing is unfolding the way it is. It's just that Mercer does not serve that segment of the market. So PFM has made a proposal to Vanguard and its clients, and they haven't communicated out to you yet, but this is part of what I'm communicating tonight, is PFM are willing to take Vanguard clients, of course, with the town's approval and due diligence, but they are proposing, we'll keep your investments and your asset allocation and even the underlying funds the same, and we'll also honor any fee agreement with Vanguard, so that does not change either. So they're willing to do that. They're being very opportunistic, and there's two kind of key points. One is Vanguard has not done due diligence on PFM. Vanguard is not recommending PFM Asset Management, but in order to help some clients that maybe need it, providing this as one additional option. I guess the attractive thing is keeping the investments the same, keeping the fee arrangement the same. But it would have to be an arrangement with this other organization, PFM Asset Management. But again, they do serve the public fund marketplace and have, I think, well over 100 clients.
Tom, Brian, I'm just jumping in. I don't think with our charter that we would be able to just jump into that. I think we have to go out to bid at this point.
Right.
They're more than welcome to bid on it, but I think
Right.
if we were just to switch this over, we would be in violation of our charter.
Right. I think a lot of folks were. I mean, they have to know that as well, meaning PFM. But that's another avenue that could be another potential bidder.
Yeah, and do you understand that this offer is made almost as like a stopgap for people that can't get their act together? PFM will just come in and just be almost Vanguard light until you can finish your process. Is that?
I think that's exactly right. I mean, PFM is, has experience with that. They clearly know what's happening out in the marketplace. Realize that kind of the time crunch that some plans are under. So for some clients that doesn't violate kind of some kind of statute, it could be a solution for them.
Does that mean that the money would be left in the Vanguard funds, Brian?
Yes, and to be clear, whether it's PFM or anyone you go to, is these same investments, these same funds would be available to you. Mm-hmm. Right? There's nothing that would preclude you from continuing to invest or invest in any Vanguard fund at any other provider. Now, some OCIO providers may say, you know what, for indexing, we have an agreement with BlackRock or State Street, and they're our index provider who we use. So that you could very well come across that. But there are other clients that say, I like the Vanguard investments. For their diversification, their low fees, etc. So,
but how does that square with Vanguard's or Mercer's decision that they don't want to offer institutional money management? So how do you invest? You'd have to be an individual, or go
how do you invest in
an
the
individual?
Fund? Can you say that question again, Chris?
Yeah, and so that's a little confusing, that you could still invest in any Vanguard fund, because if Mercer owns Vanguard, they only want retail customers. They don't want institutional customers. So how could you, how could an institution like us invest in a Vanguard fund?
Okay, so yeah, so Mercer is just buying Vanguard's institutional advisory, or what's referred to in the marketplace as the OCIO business. So I don't want to think that Mercer is buying Vanguard. Mercer is just acquiring the Vanguard Institutional Advisory division. But then to your other question is, how do you invest in Vanguard funds? You could do that through any platform. You don't have to be a Vanguard client to invest in Vanguard funds.
All right, so you buy it through any brokerage.
Yeah.
Okay.
Yep, through any brokerage, you can access Vanguard funds. Now, the town, I'm getting into different nuances because of the size of the investments, are in institutional share classes. A retail investor, just like you and I off the street, we wouldn't be in an institutional class investment. We might be in a different share class, but any individual or institutional investor can invest in Vanguard funds through their custodian, broker dealer, etc.
But this is all a little academic, Cheryl, in the sense that it doesn't seem like we would be permitted to just slide into this stopgap arrangement.
I think my concern would be also the amount of phone calls we have received from retirees. They're very nervous. For us to kind of slide in and then change again.
Yeah.
I would just rather we do it and we do it once. But I think
the other point here is that if PFM is as good an experience as they say, and I have no doubt they are, well, then they'll come in with a very competitive bid, and we can
correct
with all the others. And if so, we don't have to take them on in a stopgap way. We can take them on in a that makes some sense.
Yeah, it totally makes sense to go through. You don't want to do this again if you don't have to, and you want to be thorough and think about all the providers.
I think we have a lot of eyes on us, Brian. Retirees are very nervous, so
right.
I think we want to do it, and we want to do it right. So
absolutely, I think that's certainly the right approach.
Yeah, and so it's safe to say that all of these public entity community clients, they're all scrambling, and so the marketplace knows, right? They're all expecting to get these RFPs. They probably have their bids already in some way or measure largely already drafted and waiting to go, right?
Mm-hmm. I think a lot of, I think all of my clients have been contacted by other providers, but most are just figuring out or more than likely going out to an RFP, to make it more formal.
Yeah.
Or if they're required to.
Yeah. And Brian's been good in the sense of many different ways. He's agreed to review the RFP to make sure we have the description of the services just right, so that we're actually seeking bids for people to do the very things that Vanguard does for us, and that there's no daylight between those two, which will be very good and helpful to us. We've also tried to structure the RFP in a modular way, so that if a bidder can only provide one or two of the three service offerings, it's clear they're just bidding on one. And so that way it will help the intake and digestion of the information in the bids, and how we can kind of put them in piles or lists and whatever, and be able to deal with all that information. But some bids will come in and they'll be one-stop shopping, and other people will say, well, we'd love to do this, but we can't do this or that. And then we need to think about, if we really feel like one or more of the finalists can only do some of these other things, we have to be prepared to find finalist bidders that can do the other pieces, right? So
I think that's the trickiest part, is that some providers will naturally just not do pension payroll.
Yeah.
they may have a preferred list of providers that they work with,
Yeah.
but that company may not provide it, just like Vanguard does.
Yeah.
Yeah.
Well, and then I just wonder, Brian, would you be able to eyeball our list? Is there any? There's no issue with that, is it, Cheryl?
Yeah, I haven't been told anywhere internally, yeah, that, you know,
Just, you know,
I'm willing to help in whatever way I can, yeah.
Thank you.
Yeah, that would be helpful.
Hopefully, Brian, I can get that out to you. I would say maybe by Thursday. Lori just
Okay.
needed a couple days.
Okay.
I'm just wondering whether we could get our hands on the RFP that Greenwich is using. You know, because instead of reinventing the wheel each time, seeing what other towns are putting in their RFPs.
It's a good point. If it has been posted, it'd probably be worth getting a copy to Lori.
Yeah, and I mean, you all may have, I don't want to be presumptuous, but if you may have a contact, but if you need a contact at any of the other towns I work with, I'm glad to provide it. I'm sure they'd be glad to speak to you, yeah.
We can reach out.
Yeah,
Okay.
if someone could get a copy of that and then
Yep.
get Lori, you know, for what it's worth, I found Lori to be quite good. Yeah, that's it's not really my area, but
Right. She's very good.
Yes, yeah.
yeah, and I like to think I'm not an easy grader. Anyway, well, good. So I appreciate that, Brian, as you mentioned a couple of times. I think we will take you up on, you know, just kind of updating as soon as those December numbers are available. If you run those through again and get them to Diane and Cheryl, that would be very, very helpful. And they'll distribute them among your committee here. But it'll be helpful for us to see the actual year-end numbers and how that all works. We start thinking about, you know, ADAC and those sorts of things. Okay, any other questions for Brian about his reports or the transition or anything else? No. Okay. Well, Brian, you know, sorry we couldn't meet in person, but I don't think I'm just glad this isn't a high definition camera.
Yeah. And you know, I don't know what the RPAC schedule is, but in the coming months, you want to set up another meeting, you want me to come out there, I absolutely will do it. You know,
yeah, we very well may, and we, you know, genuinely appreciate the offer. What's more is I think you can probably anticipate at least a handful of calls as we sort through some of, you know, all of the bids that come in, whatever. We'll probably have some questions that would benefit from your market understanding and intelligence, and what do you think they mean by this and that kind of thing.
Right. Yeah.
That would be great.
Okay. And so you said that the RFP may be finalized by the end of the week or Thursday, right?
I'm hoping. Lori told me she needed another 1 to 2 days. So everything is done on our end. Tom took a look at it. We put all the finishing touches, and I just wanted to make sure she was good with it.
Yeah. I you know, I think timing should work out, right? I mean, yeah, if you gave, let's just call it a month for bidders to respond. Well, I mean, you probably want to bring them in, do a finals. Yeah, I you know, I think you're on the right path.
And certainly the sooner or the quicker the better, should I say, because we're all going to be scrambling at the same companies right now.
Yeah.
So they're all going to have a lot of, you know, if you have that same company that's good and they're getting a lot of winning bids from clients from wherever, we're competing with getting them and making sure that they can get us up and running in time.
Yeah.
Right.
Yeah, I mean, that's one of the things that we've discussed in this is that, you know, the cream will rise to, right? We probably look, you know, a handful of, you know, there'll be lots of things, but when we get down to it, we're all going to be looking at the same handful of firms and who can do what and how that all works. And as I said, if it feels like the leading bid is for one or more firms that don't do all three, then we got to find the companion service provider for the missing piece to make sure that we're covering the waterfront. So,
Right.
okie doke. Anything else for Brian? Okay. Well, 7:45. I lasted without fainting. Well, thanks everyone. And we'll look, Brian, for your revised report with the December numbers when they're available. And then, yeah, Cheryl, as soon as you can get that RFP back out from Lori, that'd be terrific. And then I guess we have full Board of Finance next week. Is that right? I think that's right. Yeah, next
Yes,
Tuesday.
we do.
From tomorrow.
Thank you all.
Okay.
Yes, thank
Well,
you.
thanks. So
Okay.
much, guys. Appreciate it. So I need a motion to end the meeting.
I so moved.
All
Second.
set. James, okey doke. All right, thanks so much.
All right.
Thank
Feel
you.
better.
Hey, everybody.
Feel better,
Feel
Tom.
better. Bye-bye.
Thank you. Bye-bye.